So I was complimenting Kevin earlier. This is probably like the best, high quality group of people and venue, at least for a crypto event. I've been at it a long time, a lot better than where I was earlier this morning. You couldn't hear anything. But anyways, I don't know how many of you know what Kevin and ETHGas have been up to. I could just tell you, I think it's on the bleeding edge, and they're so far ahead of pretty much everybody else that has been looking at this, and I have that perspective, having been working on the bring base sequencing and pre-confirmations with a group of friends over the last 18 months or so. So I'm a big fan. I think that, frankly, the reason I'm here is because I don't think Kevin and the team are promotional enough or have raised their own awareness enough. So I wanted to help out, and I do think that bringing a more kind of three-dimensional kind of markets-based approach to not only just ETHGas, Ethereum gas, but to Blockspace commitments is a huge unlock. And I don't think we've really even, I at least have not really even fully imagined what the whole range of markets we can have. So without any more, I'm going to give it to Kevin to tell us about it.
All right, thank you, Sam. Go. So we've heard from some of the roll-ups earlier on scaling, and so as it relates to scaling, there's maybe broad sweep, perhaps two approaches. One is on the throughput side, which is the L2 is now pumping out from hundreds to thousands and hundreds of thousands of TPS on Ethereum, and that's incredible. But then there's the other side of the equation, which is the latency side of the equation. How do we get Ethereum to be a real-time network? How can we give instant confirmations on Ethereum? And that's where guys on the pre-conf side come into play. And so when we think of this dynamic, it's not just that basic building block of a pre-confirmation. It is what is the ability of a validator to sell some block space in advance? What does that represent? Where can we build from that, and where would the market go? And so today I'll walk you through a little bit of our thought process in relation to the market construction for this new industry. In relation to TradFi or the real world, we have basically commodities futures, electricity futures. This is really no different in that context. We're trading the very fabric of blockchains, and it's not just Ethereum. It could be any proof of stake in that context. So from a high level, gas, we have two parts of it, the base fee and the priority fees. And so the base fee is, as you guys know, I guess it may go up and down by 12.5%, and in this diagram it's not that interesting. But importantly, the base fee has an annualized vol of 2,000%. And so when you put this into context with, say, Bitcoin or Ethereum as a token with vols of 50 or 75%, the base fee is an extremely volatile asset, potentially the most volatile asset in crypto. Beyond the base fee, we have priority fees. And so there's maybe two parts to this. One is just public order flow, accessible within the public mempool. And then we have private order flow, facilitated largely through builders and sophisticated players. These basically go through block builders. And in my mental model, I think of block builders as OTC players in the context of they can provide the flexibility, the privacy. They can basically do, I wouldn't say off-market, but basically custom transactions based on whatever you like. So in that context, I think of them as OTC players, whereas on our side, you'll see shortly, we're more of a real-time exchange. This block building process is, I guess many are familiar with it, but it basically starts with users submitting transactions to builders. These transactions are brought together within a block. They go to relays, to validators, and they eventually get proposed. The difference here is that going from a spot, so I'm using TradFi terms, spot, as in the current. We're going from an auction mechanism to a marketplace mechanism. And with a marketplace, you're going to have, again, continuous price transparency. There's going to be continuous real-time trading. It's low latency. There's standardization. There's composability. That's the benefits of a marketplace. Now, what we do is basically go to the validators and say, your block is coming up in 64 slots. Why don't you sell a portion of that or sell the entire block? And so it's basically the PBS flow kind of backwards to start. So it starts with the validators going through the relays, or gateways as we might call them, to a marketplace such as us to construct part of a block using constraints. Once that block eventually rolls down and time passes and it gets to now, we pass these constraints to a builder who can then fill the rest of the block with whatever they'd like. And so this then follows the standard PBS pipeline itself. And so everything we do is basically in advance of the current block building process. Now, when creating products for Blockspace futures, the optimization exercise is really around user experience. It comes from who are the players that interact on Ethereum, and what type of experience would they be looking for? Importantly, this is all happening at the execution layer, so like the tips and priority fees part of it. And so the basic building block is inclusion pre-confirmations. And so we're taking a 12-second block, and we're basically splitting it into 2-3 millisecond latency on Ethereum. And so that's incredible. We have, on the one side, we have L2s giving us hundreds of thousands of TPS, but now we're basically able to match that on the L1 itself with real-time latency. So that's an inclusion pre-confirmation. These basically unlock, as I said, real-time pre-settlement, as well as certainty. Am I going to be in this block or not? Am I bidding the right price or not? If you've bought and acquired that pre-confirmation, you're guaranteed to get in. On the pricing side, various approaches to pricing, but broadly speaking, it's a function of remaining block space, order flow, and on the longer end part of the market, expectations around block space utilizations. If anyone's interested on pricing, I can share some stuff later on. A whole bunch of us in Thailand kind of got together and kind of before and after, and we've kind of grouped together a bunch of research on this topic. The whole block market is, in my perspective, a lot more interesting. I'm going to have Jack, if you could switch over to the exchange. Okay, here we go. So this is our DevNet. We would otherwise be showing part of Haleski. But this is the trading of block space in real time. So maybe I'll go over to this monitor here. At the top side, that is the price for a block. And so, well, rather, it's the last traded price for a block. We basically have 64 slots that go all the way out to the right. And you'll see it eventually roll down to 32 slots, and then another batch of 32 blocks will appear. But there's a couple considerations here. As a validator, well, I guess one of the questions that's come up regularly is, if I'm a trader and I go to a validator and say, hey, I want to buy some block space, like, what's the price? Validators are not financial players. They're infrastructure experts, but what is the price? Do we rely on a model, like an algorithm? With us, we basically say it's the market price. Let's let the market decide. Now, when a validator sells blocks, there's a few approaches. One is just a default approach and say, I want to sell my block into the marketplace. When there's a bunch of bids there, that's the market price. All the market information has been digested at that point. That's the best price I will ever get. So that's kind of a default option. Secondly, for a validator, you can say, well, hey, I'm sophisticated. I know how to get some alpha. I know how to sell this block like really well. Great. You can basically connect to our API endpoints and sell the block however you want, full customization. Or you might say, I don't know how to maximize it, but there's this company over here who are experts in this space. I'm going to get them to sell it. So you can basically delegate to a third party. And so that's the selling of the block space. On the buying side, again, I can buy a block at 64 slots out, and as it rolls down to now, well, I guess I could sell the block 2 seconds later if I like. So the carry-in cost is nothing. But as that block rolls down to now, and it needs to be built, you can basically build it yourself. And so it basically secures sequencing rights for you. You could buy 1 block, you could buy 2 blocks or more. So you can build the block yourself. You could, what was the second option here? The second option is you can basically say, I don't know how to build blocks. I can't really maximize the value of this block. But what I could do is say, I'm going to put my trades top of block, and I'm going to then delegate to someone else. I'm going to delegate to this builder, maybe Titan builder or maybe BTCS, and say, I want to delegate to you guys. Please fill the rest of the block and pay me some residual value from that. Or you can even send it up for public auction. It's entirely up to you. But the point is that there's this control. Or you can also delegate to us to build, but we're not great builders. I'll put that out there. Yeah, so on the validator side, a few options in terms of how you sell. And once you've owned the block, you can basically sequence it as you like. Down here in the second column, that's the price for inclusion pre-confirmations. So that's just getting like a slice of the block itself. Okay. Jack, if you don't mind just switching back. Thank you. All right. There we go. Okay, so the whole block markets, it unlocks this certainty. There's this question as a trading firm, I want to put my trades in, but they're going to go to, this block builder or another block builder. But is their block going to be proposed? I don't know. There's a risk. So there's uncertainty in terms of which builder's block is going to be chosen. And furthermore, for that builder, there's uncertainty over which trades are going to be confirmed for that builder as well. If you take some of the larger builders, they can't service all of their 100 clients at the same time. They have to make a decision as well. So this kind of removes that uncertainty from the equation. Secondly, there's multi-block initiatives, which I won't get too deep into. On my side, I'm especially interested in it from a product design standpoint, and I will talk about this shortly. Thirdly is this composability with the macro markets. I'll also touch on this very shortly as well. And then finally, I guess the fourth thing is basically event-specific circumstances. And so if there's a big NFT drop or something really exciting is happening at slot 43, then hey, I want to buy slot 43. That'll be worth more. Okay. Okay, I kind of missed some of this. Yeah, short end side of the equation, we covered that. Mid-end volatility, blah, blah, blah. Oh yeah, base fee also, sorry, this is on pricing. Base fee comes into the pricing dynamic here as well. I still need to wrap my head around it, and I'm open for further discussion on it. But in the context of interest rates in kind of the TradFi world, that base fee forms some type of discount rate as well for the pricing of these instruments. We've yet to fully unpack it. If anyone has any great ideas, please reach out. Kind of want to figure out the mental model for that. In the longer-term Blockspace pricing, when you go beyond 64 slots, minutes, or hours, or weeks, it's basically a vol trade to some degree, right? There's if hypothetically, you can basically buy 24 seconds, 12 seconds, or 24 seconds of Ethereum. That's a straddle basically on the network for a trader. And so I can basically short a straddle on Deribit, and I can buy blocks on Ethereum, and that's basically a long short trade. And so through some type of decomposition, we can basically price blocks based on the price of vol on Deribit. So I wrote an article on that. If anyone's interested, reach out to me later on. But what it does is it forms a baseline for the price of blocks. And so even if gas right now is 1 gwei, if ETH vol is 75, a block should be worth around 5.5 gwei. And you can find out more in that article. Ultimately, there's what impacts block pricing further out is just technology itself and scaling. We don't know what's coming down the pipeline. We have some transparency, I guess, over what the Ethereum Foundation is going to do, but all this is going to impact how blocks are priced a little bit further down the line. In terms of our roadmap, again, it comes to a user experience. You have, on the one hand, your everyday person who says, Ethereum's 12 seconds are too slow. I want like real-time confirmations. And okay, cool, we've done that. Inclusion pre-comps. You have other guys who are like, hey, I want to extract more MEV. How do I do that, right? And so, I mean, you can do that too. You have other guys who, well, actually, I'll get to it shortly. But it's all based on user experience, and it really comes down to there is a price for this instrument. Let's let the market decide, right? So blobs is one market where we have a number of L2s who need to compete for blobs. Separately, we've spoken about inclusion, but as well as exclusion as well. There are some cases where you might want to exclude some type of transactions as well and pay for that. Coming to multi-block, this is one of the cool ones that came up in discussion, which is, basically that if the price of gas is like 5 gwei, you could buy an inclusion in that block for say, half the price with a guarantee of settlement in any of the next 4 blocks, right? Maybe you don't need settlement in this block, and so it's basically like a slow lane, but still guaranteed settlement. That's great. Another one is like state access. And so the idea came up, could I just buy all of like Uniswap's state access and just that's all I want to control or get access to? And it's possible, right? Who is the buyer for that, and what's the price? Is it Uniswap themselves who want to sequence the Uniswap themselves? Sure, that can be done. And so that's something as well. It can also be applied in other ways, for example, on an Oracle or a lending protocol. Which opens up kind of the other side of the question, thinking about Bybit, of course, in the news recently. It's that I don't know who proposed some of the blocks, but it'd be a tragedy if Bybit actually proposed some of the blocks that were linked to their hack. And so there's no real marketplace around, how could a firm prevent some type of on-chain transactions? And so this came up from the perspective of like, well, if I'm a big exchange, could I buy insurance from some set of validators to prevent transactions of greater than X being transferred from my exchange to some unknown wallet? And maybe there is. Maybe there's a price for it. Separately, it's like a liquidation insurance. We've had people who've said, hey, I'm on like Aave, can I just buy like 2 or 3 slots? Either like a liquidation insurance, and basically if I'm going to be liquidated, I want to get in front of that transaction and be able to top up before that liquidation happens. Again, there's a price for these instruments. That's all execution layer. So on the base fee side of things, I won't dive too deeply into it. There is a nuance around base fee futures where market manipulation really comes into play, and it's something we want to avoid. Arguably, if you create a base fee future marketplace, you could go long like $1 million of base fee and then just stuff a bunch of garbage in the block and drive up the price of that block. And so that creates these obvious negative externalities. And so that's something we'll be avoiding in our approach, but I'll be sharing more on that very shortly. Most importantly, though, is that our base fee futures will be fully integrated with our physically delivered futures markets. And so in between the pre-confirmations and the block markets, as well as base fee, you're really getting into the entire stack. And so on the left side here, it's basically the different types of users and that user experience they're looking for on Ethereum. And then as we flow through to the right side, it is that optimal block that maximizes the value for the validators. And so again, as I said from the start, this is all about how can we create a suite of products? We're starting with like a vanilla spot auction. How can we create 10 different flavors of ice cream and maximize the demand side of the equation, and ultimately pay the validators more on the supply side? And so instead of this, a volatile gas market, we get this. You get certainty. All right, you can hedge the entire stack. And so, this is what we call the gas stack. And I want to just discuss briefly kind of like where does this take us? Because it's all going to happen very quickly. And so, we have an improved user experience for all those sets of users. We now have full risk management capabilities for anyone that wants to do something with gas. And from a risk management standpoint, that opens up this idea of a gasless Ethereum. And so there's been this notion that, in the real world, if I buy a coffee, like I'm not charged extra for the price of electricity that day. Or if I buy a chair, I shouldn't have to think about the price of electricity. Gas is like an industrial input. So shouldn't the protocols kind of factor in gas somewhere in the background, and they just charge me my regular transaction fee? It's entirely possible. Absolutely impossible. Absolutely possible with this framework, because we can go to a protocol and say, hey, your users spend $1 million on gas at this time of the day, and in this manner. You can basically fully hedge that risk with us, and now you can completely remove gas from that end user experience. And so that's the economic side of the equation. And when you can cover the economic side of the equation and couple it with the technical side of the equation through account abstraction and paymasters, then you can completely remove gas from the end user experience. We have about a dozen protocols that are working on this with us. If anyone out here is driven by gasless Ethereum, please reach out, and I can tell you a little bit more about it. Did I cover this here? Yeah. Okay. Fixed rate staking. That's the next one. So when you're buying a commitment, it's basically a guarantee. I'm going to a validator and saying, hey, I want to buy your Blockspace, some minutes or weeks or potentially months in advance. And at the same rate, that validator or a user can hedge the base fee. So altogether, your kind of fixed plus floating is just a fixed rate fee. And so this is it like a corporate credit risk? I don't know. But it's the ability to introduce like a fixed rate staking product, directly in this block building process. And to me, that's fascinating coming from a TradFi world, because fixed rate staking invariably leads to a yield curve. And to me, this is the holy grail, I think, of blockchains, because largely it can be integrated within the real world. For years past, if people are getting their salaries in ETH, like how do you hedge that? Right? You can't hedge it back into dollars or some kind of real-world fiat currency. Should you do that as something else, right? But it's just having composability with the broader financial system, and that's where a yield curve and interest rates come into play. And so this is my map of kind of the product of the financial markets. And so as we can basically build that yield curve, and we can introduce credit, validator credit perhaps, that will then spin out and allow Ethereum to grow as not just like a world computer, but almost like a world economy that's much more tightly integrated. And that's it. This really starts with Blockspace futures, right? As I said, inclusion pre-confirmations is real-time Ethereum, and the ability to buy blocks in advance for the traders and sophisticated parties. It opens up a really different dynamic where today you have a couple dominant block builders to open access. You have the current block builders who can put bids on blocks. You have any of the 100 quant trading firms that can put bids on blocks. You have just speculators who just want to take bets on the price of gas as well. But it basically opens it up to the broader market. And I don't know how this is going to go, but with transparency and price discovery, I feel like we'll end up in the right place. And so with that, I'll leave it there. If there's any questions, I'll take those as well. So happy to take a couple questions. We have a few minutes. Over there. So an inclusion pre-confirmation is basically that I'm getting some amount of block space. I'm getting 1 million gas within a block space. But it's not necessarily at the top of the block or the bottom, it's just somewhere in the block. And so that's arguably the cheapest type of gas. It just guarantees that I'll be included in that specific block. An execution pre-confirmation is basically this idea that I'm getting some gas, but I'm getting a guaranteed result. And so I don't just want to do a swap, but I want to do this swap and get a certain price. Or I want to do this type of MEV or sandwich attack, but I want it to be successful. And so, again, with these guarantees, there's different prices for them. But that's, as this market develops, we'll be talking with the traders and solvers here on exactly how to execute that. I think I saw another question in the back. Well, inclusion pre-comps and the entire block markets are coming next week. So if we have the validators online next week, then we'll be live. So yeah, the inclusion pre-comps and the whole blocks very soon. Yeah. Yeah, good question. So the question is, what happens if the validators don't follow the rules or the guarantee? And so the validators need to post collateral to honor these commitments. And so as a validator, I need to post X, like a certain amount of ETH, to honor this commitment. And so that was a previous conversation with Brandon at EigenLayer. But yeah, we'll be working, with us specifically, the validator could post collateral directly to us, or they could restake that collateral through us with EigenLayer, and that's much more capital efficient in that regard. One of the nuances is how much collateral should be posted. And there's various questions. On the one hand, you have if a validator posts 1 ETH, it's very accessible for any validator to post 1 ETH. But in reality, maybe they should be posting 30, 50, or even 100 ETH. But how do they go about that? And so, we've seen some very profitable MEV trades in the last week with all the volatility. Actually, in the last 24 hours, where that number is closer to 50 to 100 ETH. Yeah, so basically, the more collateral you can post, the higher people will pay for your block space. Yeah, and so if you have a sufficient amount of collateral, then again, the more that you post, the higher people would pay for that block space. Yeah. Yep. Absolutely. So today it's just 64 slots. It's about 12 to 13 minutes, but we can absolutely do that much further down the line. Yeah, it basically turns into a vol market. Exactly, right? So you're trading you're trading vol on Deribit or somewhere else versus this, and I don't even kind of need to care about the physical delivery. It's purely just a vol play for me. Yep, yep. Exactly. Yeah. The further you go away from the physical delivery part, the more it becomes a vol or a macro hedge. Yeah. Ah. Sorry.
The collateral, is it deposit or hostage? Is it that do you recompensate when somebody validator doesn't do what they to the people who actually lost, so to wait for recompensation, or do you just take it away? And also, do you take it away proportional to how much loss they had from the user experience perspective, or is it a fixed rate that you take it away? Not the amount that is lost, but the amount that is taken away.
Sure. So the question was on collateral and compensation. And so, yes. Yes and no. So ideally, the collateral can be transferred to the person who bought the commitment. And so right now, we're doing it on a linear basis. So let's just say if there was 30 ETH as collateral, then you would have basically 1 ETH per 1 million block space. And so it's right now, we're doing it linearly. It probably shouldn't be linearly, but that's what we're doing now, and we'll probably refine that over the next month or so. So good question. So that makes it, that's probably more of something that would be organized more on a local level amongst, correct. Yeah, so I think especially for small validators and kind of solo stakers, you don't have that capital. So how do you access that capital, in which case it makes sense to kind of pool with a bunch of people you know. Right.
Sorry, I was just thinking you can do a way to incentivize smaller stakers to participate.
Absolutely. Yeah, no, absolutely. So with the smaller validators, it makes sense to kind of pool with your friends, basically. But there's a trust assumption with your friends as well, right? Because yeah. So, yeah. Okay. Yes. Yeah. Sure. So there's a couple parts of that. One part is just certainty, right? So you basically have everyone across that structure who's acquiring certainty, and people would pay up for certainty. And so in the base case, if everything was a confirmation of some type, then they'd be paying more through this process. The second part is there more type of MEV that can be captured? Probably. And that will kind of add like an extra element to how much people would pay for that. So if someone were to acquire 2 blocks in a row and get top of block for both blocks, you know, they definitely pay up for that. Well, I mean, we can hear from the next panel. They might chat about some of these things, but broadly speaking, yes. Sure. So the question is around, I guess, how does the process work? So, yeah, in one of our first slides, it's basically all this happens before the block building process. So basically, we're constructing all these constraints before a block is built, and then when the time rolls down to now and the block is actually constructed, then all the pre-confirmations that were bought have to be honored in this slot itself. So we don't really change. We don't change the current pipeline and the current flow. We augment it and supplement it with a whole bunch of stuff in advance. Yeah. Mhm. Maybe. Yeah, so let's say a validator posts 30 ETH as collateral, but they might get paid 50 ETH to do something. That's the question of like validator reputation, arguably, right? Like, does a validator want to be a economically rational validator, or do they want to put themselves out as honoring all pre-confirmations, irrespective of whether it might be more economically optimal at certain times? It's basically for whoever uses Ethereum. So it comes down to an enhanced user experience for all the different types of players. And so they might be paying for like a faster settlement, just faster conclusion pre-confirmations. So it just comes down to like them getting a faster, more certain, more guaranteed experience. And that will just kind of flow through the ecosystem. Yeah. Correct. It comes down to how much collateral is being posted. Yeah. Correct. Yeah. So are validators economically rational, or do some put themselves out there as like, I'm just going to honor it no matter what, and even if someone could pay me on a one-off basis, I feel that this is like validator reputation, and I don't want to like tarnish my reputation. That's yet to be seen, but super exciting stuff, right? Is this like credit risk or not? Because like we'll see. I think like social consensus will have a role here as well, but TBD. All right. Okay, we'll leave it there. Maybe last one.
Because you said in social game is also game theory because the validator rolls back to because it's repetitive, right? The moment of iterative game theory, reputation naturally factors in because it's not like a one-time the validator is playing. So do you think the reputation, if we want to formalize the reputation?
Well, exactly, right? So if a validator like doesn't honor the commitment and does the economic rational thing, will people want to buy from them in the future?
Exactly.
Yeah.
So I think the social thing will naturally because even if we don't
Yeah.
achieve a number by kind of formalizing.
Yep. No, I would love to share some data on this and see how it goes. We'll discuss this next year at ETH Denver. Okay, we'll leave it there. Well, thank you for this, and I will now get to introducing the next panel.